Hello, this is Simon Thompson, Vice President and Wealth Advisor at Texas Legacy Wealth Management. Thank you for joining us for our mid-year review and outlook. Today, we'll review where we've been this year, current market events, and our thoughts for the remainder of 2015. Securities offered through LPL Financial, member FINRA SIPC, investment advice offered through Texas Legacy Wealth Management, a registered investment advisor and separate entity from LPL Financial. The first half of this year has brought modest stock market growth in the U.S., while the economic turnaround overseas has boosted international markets. The first quarter brought us disappointing earnings in the U.S., as we saw the economy and earnings weighed down by the strength of the dollar, weakness of oil, and the West Coast port strikes. Overseas was a different story, as we saw green shoots emerging, especially in Europe, as improving data in manufacturing, lending, and company earnings boosted optimism. Combine those factors with a commitment to stimulus from the ECB, and we saw European stocks rally. Global markets saw volatility reemerge at the tail end of the second quarter as concerns surrounding Greece, China, and global economic growth came back to the forefront. Over the past few weeks, Greek default headlines have increased market volatility, but we view this evolving situation as more of a temporary setback. The Greek economy makes up only 2% of the Eurozone economy, and the majority of Greek debt is owned by the ECB and IMF, whereas in the past, Greek debt was owned primarily by banks around the globe. This is important as it reduces the likelihood of contagion in Europe. This can be seen as bond yields in peripheral European countries, Italy, Spain, and Portugal, are nowhere near the levels we saw in 2012. The elevated levels seen in 2012 showed a concern not only about Greece's debt, but also about Italy and Spain's ability to repay loans. In addition, the ECB has stated they are prepared to do whatever it takes to control any signs of contagion. China has grabbed the headlines recently with a large pullback in its equity markets, with almost a 30% drop from the highs of the year after a large run-up over the last 18 months. Like the ECB, China has been using easy monetary policy to help support the markets and economies. This is contrary to what we're seeing in the U.S., as the Fed has stated they're moving ever closer to a rate hike. So what would a rate hike look like in the U.S.? Ultimately, the Fed has indicated they're going to be data dependent and continue to look closely at the number of jobs created, the unemployment rate, wage growth, and inflation to determine when to raise rates. At this point, the Fed funds future market shows that the first rate hike is likely in the latter stages of 2015. However, with Greek uncertainty looming and China's unstable markets, we could see this delaying the Fed decision on when to raise rates, possibly into 2016. While we do see a number of concerns globally, the question we ultimately need to ask is whether a recession is likely. We monitor the likelihood of this and the potential for economic growth with the help of our economic dashboard. We look at 6 economic indicators that have been historically significant in predicting changes in the economic cycle, as each may act as a warning sign of a recession. 4 of our 6 signals give us a green light, while 2 are in the warning mode, valuations and PMI. One of the indicators, PMI, Purchasing Manufacturers Index, showed signs of weaknesses during earlier months in the year, but appears to be bouncing back, pointing to a potential upgrade back to green. In looking at our dashboard, we're still confident in the underlying economy and believe that this strength could carry through to stocks. As such, we're still bullish and view recent stock market weakness as a potential buying opportunity. While we look at the U.S.'s PMI, Purchasing Managers Index, as part of our dashboard, we also find it interesting to look at PMIs around the globe. You can see strength picking up over recent months in Europe, China, and in the U.S. PMI is an indicator of the overall health of manufacturing. When the PMI reading is above 50, it shows expansion in manufacturing, while a reading under 50 starts to show signs of contraction within manufacturing. Positive growth in PMIs have historically suggested potential growth in earnings over the next 6 months. Corporate earnings are the fundamental force that tend to drive the stock market. While we don't see a recession as likely in the foreseeable future, we want to explore a little more closely where we are in the economic cycle. We believe we're most likely entering into the mature phase of the market as we see moderate GDP growth, a potential for interest rates to rise, and a slow return of inflation. This period may also be characterized by increasing volatility. The last 3 expansions that began in 1982, 1991, and 2001 respectively lasted an average of 95 months, or roughly 8 years. To provide some context, the current economic expansion, at about 6 years old, could have some time to run and build on the progress made so far. Often at a market peak, we see excesses in the economy that typically herald the end of economic expansion. We don't see those excesses today and remain fully invested. As we look at estimated earnings growth for each sector, we can see expectations in the energy sector are dismal, but other areas of the economy could provide a boost, led by earnings growth in financials, consumer discretionary, and healthcare sectors. Currently, our favorite sectors in the economy are healthcare, technology, and financials, as we see earnings growth and fundamental tailwinds for each of these areas of the economy. Overall, the U.S. economy continues to strengthen, and we're bullish as we look towards the end of 2015. In addition to the aforementioned sector exposure, we're believers in global investing and feel like the recent volatility in foreign markets could be a great buying opportunity and want to maintain global exposure. Despite our optimism, the recent geopolitical events and stage of economic cycle could lead to increased volatility with the potential of a larger pullback in the market. We will continue to be vigilant and prepared to make changes in portfolios if we feel the need arises. For more information about Texas Legacy Wealth Management, you can contact us via phone, email, or feel free to visit our website. We would also like to remind you to follow us on Twitter and like us on Facebook. Thank you.